Hi everyone and welcome to Learning Objective 4-2. In this learning objective we are going to account for bonds issued at fair value, at a discount, or at a premium, and recording the interest using the effective interest method or the straight line method. Alright, so as we saw in our discussion of investments, which were an asset, so an investment, a debt investment might be, say, one company investing of the bonds of another company, so lending money to a second company through bonds. And when we had an investment, we classified that investment as held to maturity, trading security, or available for sale. So if we had a debt investment, it fell into one of those three categories for accounting purposes. Alright, so now we're in this module, in Module 4, we're talking about long-term liabilities. And often we will have to account for the debt side of these bonds. So previously we talked about the asset side. How do we account for the investment? Well, how does the company that's borrowing the money do the accounting? And just like we saw in the investments discussion, the selling price of a bond does not always equal the face amount of the bond. And why is that? Well, there's almost always a delay between the date the terms of the bond are established and when the bond is actually sold on the market. So this delay causes a fluctuation, or the market value or the market interest rate for bonds that look very similar. That market rate has fluctuated between the time that the terms have been agreed to for this company's bond issuance and what similar bonds are offering in the market. So if we have two identical bonds in terms of risk and maturity and size, what's going to happen if one bond is, say, paying 12% while the second bond is paying 10%? Well, chances are investors are going to be attracted to the 12% bond. It has a higher coupon rate. They'll receive more interest revenue. So what does the company that's trying to borrow using bonds that are paying a 10% coupon rate, what can they do to attract investors? Well, in this scenario, they would lower the price of their bonds. So they would offer a discount to bond investors in order to attract those investors so that they would invest in the lower interest rate bond. All right, so they have to offer a discount to make it attractive to investors. And it turns out that discount that's offered is structured in such a way that the lower coupon rate bonds will effectively yield whatever the market interest rate is at the time. So when we calculate the discount, we calculate the discount in such a way that when you factor in the discounted price and the 10% coupon payments, those bonds effectively will yield 12% interest. All right, so that's what we're doing here with adjusting the selling price of bonds. All right, so the rule of thumb, or the rule here, is that if the coupon rate of a company's bonds is lower than the market rate of interest, the bonds will sell at a discount, and vice versa. So if the market rate is lower than what the company's bonds are paying, the bonds will be able to sell at a premium. So how do we determine interest expense if we are the borrower, if we're borrowing money through bonds? So the effective interest on debt is the market rate of interest multiplied by the outstanding balance of debt. And so the effective interest method says that the interest expense recorded each period should be based on the market rate of interest rather than the stated rate or the coupon rate. All right, so we've talked about bond selling prices and how we calculate effective interest. Let's talk now about debt issuance costs. So when issuing bonds or notes, a company will incur debt issue costs, and these costs include legal fees, accounting fees, printing costs, registration fees, underwriting fees. And so an underwriting fee might be a fee paid to a commercial bank such as Wells Fargo to facilitate the process of identifying investors for your bond issuance and actually getting these bonds sold. So handling the administrative tasks associated with selling bonds. So all of these costs are necessary for borrowing the money. They're issuance costs associated with issuing new debt. So what do we do with these costs? What ends up happening is we still owe the same amount of money to the lender, right? So if we're the borrower, if we're selling bonds, we're borrowing money through bonds, right? We are still going to owe the same amount of money to the lenders, the bond investors, but because we have these debt issuance costs, we're going to receive less cash up front when we borrow the money. So we deduct the debt issuance costs, things like legal fees, accounting fees, underwriting fees. We subtract that from the cash proceeds that we would otherwise get. So we get less money up front when we borrow these funds because of debt issuance costs. That's the moral of the story here. All right, well, in this video in Learning Objective 4-2, we talked about calculating the selling price of bonds, how the effective interest method is used to calculate interest expense, and we also talked about debt issuance costs. So I hope you found this video helpful. Thanks a lot for watching. Take care.